Welcome back to the Deep Dive. It is Saturday, February 21st, 2026. And if you have been staring at your portfolio this week, you might be feeling a little bit of motion sickness.
Yeah, motion sickness is definitely a polite way to put it.
Right. Because we essentially saw a month's worth of volatility packed into just 5 trading days.
We really did. I mean, it was a totally whiplash week. We had a head-on collision between the White House and the Supreme Court, and then we had the AI narrative colliding with this very harsh geopolitical reality. And investors were basically just caught in the middle trying to figure out which way was up.
It honestly felt like 2 completely different markets, depending on which day you logged in.
Yeah.
You know, you had tariffs appearing out of thin air on Monday, vanishing by Friday.
Oof.
Gone. Exactly, gone.
Wow.
You've got robots doing backflips and viral videos, and Wall Street collectively holding its breath for what feels like the Super Bowl of earnings next week.
And that's exactly why we need to do this deep dive today. Our mission isn't just to recap the headlines you already saw scrolling on your phone. We really need to parse the noise.
Yeah, we have a massive stack of reports to get through today. Everything from macro data on GDP and inflation to some really specific, really dramatic stock moves.
Right. Biotech disasters, massive buyouts in tech.
Plus, we need to talk about the drums of war beating in the background, because commodities are starting to move in a way that suggests people are getting pretty nervous.
They are. The risk premium is absolutely back on the table. So we're going to break this down into 3 parts for you today. First, the macro timeline, specifically that tariff drama and the data tug of war.
Yep.
Second, the idiosyncratic stock mover, so your winners and your losers. And finally, the geopolitical picture involving oil, gold, and bonds.
Perfect. So let's start with the main event, the tariff drama. It felt like a legal thriller playing out in real time this week.
Oh, totally.
Walk us through what actually happened here, because the timeline really matters for the context.
The timeline is crucial to understanding the volatility we saw. So kick it off on Monday. The market opens to a massive shock. President Trump, in a move to strike back at a previous Supreme Court ruling regarding trade authority, decided to leverage more tariffs.
Not just targeted ones, right?
No, not at all. We're talking about a blanket 10% across-the-board increase on global allies and foes alike.
Which is basically the nuclear option for global trade.
It is. It's an inflationary bomb. And the market reaction was immediate, and it was negative. Traders just instantly started pricing in higher costs for everything from electronics to lumber.
Because the narrative early in the week was suddenly that the global economy was being put in the penalty box.
Exactly. It felt incredibly heavy. But then you fast forward to Friday, and the script flips completely.
Completely upside down.
The Supreme Court stepped in and officially struck down these global tariffs. They essentially ruled that the executive branch had overstepped its authority in this specific context.
And obviously the market absolutely loved that.
It loved the certainty. It wasn't just that the tariffs were gone, it was the mechanism. By the Supreme Court stepping in, it tells the market that there are strict legal guardrails on trade wars right now. It fundamentally lowers the long-term risk premium for multinational corporations.
And looking at the board on Friday, the reaction was violent to the upside. Big tech obviously led the charge. I'm seeing Alphabet up 3.7%, Amazon up 2.6%, Apple adding 1.5%.
Right, because those are the companies with the most complex global supply chains. If you put a 10% tax on moving goods across borders, Apple's margins get crushed.
Yeah, you take that tax away and suddenly that cash flow looks a lot healthier.
Exactly. But it wasn't just tech, though.
No, I noticed the home goods sector caught a massive bid. Wayfair and Williams-Sonoma were just flying.
That's a direct correlation. Think about what they sell. Furniture, kitchenware, a huge chunk of that is imported. If those tariffs had stuck, Wayfair would either have to eat the cost, which they can't afford, or pass it to consumers who are already totally tapped out. So when the threat evaporated, their business model basically breathed a huge sigh of relief.
Okay, so the tariff scare ends with a massive relief rally. But while the headlines were cheering about the Supreme Court, the actual economic data underneath the engine room of the economy was making some strange noises.
Strange noise is putting it mildly. It's more like grinding gears. We had a classic tug of war between growth and inflation this week. First, let's look at GDP. It came in extremely soft.
Now, the president was out there immediately trying to spin this, right? He blamed the government shutdown for the drag.
And to be fair, he's not entirely wrong. Government shutdowns do artificially depress GDP data in the short term. But investors are looking right past the excuse.
Because the fear is that even without the shutdown, the organic growth is just slowing down.
Exactly. If the AI story, which is basically holding up the entire S&P 500 right now, doesn't translate into real productivity gains soon, and GDP is already sagging, are we looking at a recession in late 2026?
That's the big fear. But usually, if growth is slowing, the Fed cuts rates to help out. The problem is they can't do that if inflation is sticky. And the PCE data this week was a mess.
It was incredibly messy. We saw some initial headlines celebrating cooler than expected readings, which fueled some hope for rate cuts early in the week. But you have to look at the details.
The devil is always in the detail.
Always. One deeper analysis of the personal consumption expenditures, which is the Fed's favorite gauge, showed it was actually terrible. It was up 0.4% month over month versus an estimated 0.3%.
That's a 0.1% difference. Doesn't sound like much to the average person listening. Why does that matter so much to the market?
It matters because of the trend. The prior read was 0.2%, so we went from 0.2 to 0.4. That is an acceleration in the exact wrong direction. If you annualize that 0.4%, you're looking at inflation running hot again.
Which puts the Fed in a total bind.
A complete bind. And you saw that clearly in the Fed minutes released midweek. It was house divided. You have some policymakers looking at the soft GDP and saying, we need to cut, and others are looking at that PCE number and saying, if we cut, inflation explodes, we might even need to hike.
Wow. So a paralyzed Fed, a soft economy, but a tariff relief rally. It's a very confusing mix.
It is. But here's the vibe check for you as an investor. Despite all the tariffs, the bad data, the Fed confusion, the S&P 500 actually held up.
I was looking at the chart for the SPY ETF before we started recording. It looks like it's painting itself into a corner.
Technically speaking, it's in a bearish ascending wedge.
Okay, hold on. Bearish ascending wedge. Break that down for us visually.
Sure. Imagine two lines moving upward on a chart, but they are getting closer together. They're converging. The price is going up, but the trading range is getting tighter and tighter. Visually, it looks like a wedge pointing up.
Got it.
Usually, this pattern exhausts itself and breaks downward. That's why it's called bearish. The market actually tested the bottom line of that wedge this week, threatened to break, but then bounced.
So the floor held.
It held. It stayed in the channel. But it feels like the market is just treading water right now, waiting for the one thing that actually matters.
Nvidia earnings next week.
The macro market mover, the AI reality check. At this point, the entire stock market essentially feels like a derivative of Nvidia. If they deliver, the wedge might finally break upward. If they stumble, that bearish pattern likely plays out violently.
It's incredible how much weight is sitting on one single stock.
It's the engine of the market right now.
All right, so we've covered the big picture macro. I want to zoom in now on some specific companies because there were some wild, idiosyncratic stories this week, from massive buyouts to absolute disasters.
It was a very stock picker's week.
It was. But before we get into the winners and losers, I want to take a quick second to level with you. We just mentioned Nvidia earnings coming up. But next week is actually even heavier than that. We have the IMF releasing its Article 4 report, which is basically the audit of the U.S. economy. And Congress is actually voting on an Iran war powers resolution on February 24th.
The news cycle is accelerating incredibly fast. It's not just noise anymore. These are pivotal events that could define the next 6 months of your portfolio.
Exactly. So if you want to make sure you have someone parsing through that madness for you, please hit that subscribe or follow button on whatever platform you're listening on. Leave a comment or a like if this deep dive is helping you connect the dots. We do this to make you the smartest person in the room, and we do not want you to miss what's coming next week.
Absolutely. Next week is going to be a defining moment for 2026.
Okay, let's get back to the chaos. Part 2. Stocks. Idiosyncratic movers. Let's start with the people popping champagne. M&A is back.
Mergers and acquisitions are definitely back, specifically in the medical device space. The absolute headline grabber was Masimo, ticker MASI.
I saw that chart. It looked like a literal rocket launch.
It really did. On February 17th, the stock jumped 34%.
34% in a single day. That's a life-changing move for a trader. What exactly happened?
Danaher came in with a massive checkbook. They announced a $9.9 billion cash and stock deal to acquire Masimo. Now, Masimo is best known for those pulse oximeters, the little clips they put on your finger in the hospital to check your oxygen levels. It's a massive exit for them.
And Danaher. Usually the company doing the buying sees their stock drop because they're the ones spending all the money.
Exactly right. And that held true here. Danaher shares fell about 3%. Investors always worry about overpaying or integration risks with a buyout that size, but for Massimo holders, it was just a massive payday.
Good for them. We also had some action on the high seas. Norwegian Cruise Line, ticker NCLH, up about 12% on the 17th. Was this another buyout?
Not a buyout, but an intervention, let's call it. Activist investor Elliott Management announced they built a stake larger than 10% in the company.
Elliott Management. They have quite a reputation. They don't just buy stock to sit on it and collect dividends.
No, they buy stock to shake things up. When Elliott shows up on your shareholder list, it usually means aggressive cost-cutting, management changes, or strategic shifts to squeeze out shareholder value.
And the market loves that.
The market loves an efficiency narrative, hence the 12% pop. Investors are basically betting Elliott will force Norwegian to run a tighter ship pun, fully intended.
I appreciate the pun. But look, it wasn't all easy money this week. We have to talk about the dark side of investing, specifically in biotech. Grail, ticker GRA. This was heartbreaking.
This is a brutal reminder of the risks in pre-revenue or binary event biotech stocks. Grail stock suffered a massive $50 drop this week.
$50 per share wiped out. That is catastrophic.
It's a true cautionary tale. Grail was conducting this massive study called the NHS Gallery Study. We're talking 142,000 people over 3 years. The Holy Grail, again, pun not intended but fitting, was to prove their blood test could detect cancer in the early stages and actually shift health outcomes.
And it didn't work.
It failed to show a statistically significant improvement in the key outcomes. It just didn't shift cancers to early stages or reduce late-stage cancer diagnoses enough to matter statistically over that 3-year period.
That is devastating, not just for the stock, but for the medical hope behind it.
It is, and financially speaking, the chart is completely broken. It's smashed right through the critical support floor of $93.
Why is $93 specifically important?
In technical analysis, that was the line in the sand where buyers had historically always stepped in to support the price. Once you break a multi-year floor like that, there is no structural support underneath. It's in free fall. Analysts are now warning it could slide to $84 or even $75. It's in no man's land right now.
Brutal. Okay, let's pivot to a stock that lives almost entirely on narrative right now. Tesla.
Tesla is fascinating right now because the actual car business is almost secondary to the broader story.
Right, because I keep seeing these videos of Chinese robots doing backflips and holding machine guns. And the narrative on Wall Street is Tesla is the U.S. answer to this.
Precisely. The Optimus robot narrative is keeping a massive premium in the stock, but narratives don't always support technical charts. Tesla is hovering around a very dangerous spot right now, $411.
What are the technicians watching for?
The magic number is $415. The bulls need the stock to close the week above $415 to let everyone know they have regained control. If it slips below $408 or breaks $400, the chart suggests a much deeper correction is coming. It's a real-time battle between the robot future hype and the technical reality of the current stock price.
Speaking of technical reality, let's look at Alibaba, Bibaba. You mentioned a specific candle pattern here in the notes that sounded pretty ominous.
The gravestone doji.
Okay, visualize that for me.
Picture a standard bar chart. A gravestone doji is a vertical line with a very small horizontal line near the absolute bottom. Visually, it looks exactly like an upside-down T. What it represents is a failed rally.
How so?
It means that during the time frame, and in this case we are looking at the 2-month chart, which is a very strong signal that buyers pushed the price way up, getting everyone excited. But by the close of the period, sellers had crushed it all the way back down to exactly where it started. It looks like a tombstone for the rally.
That does not sound bullish at all.
It's a classic reversal signal. The triggers are very clear now. If BABA can manage to close above $165, the doji is invalidated, and we could see a run to the 180 to 192 range. But if it closes below $152, that gravestone is confirmed, and we could easily see a drop down to 137.
Got it. Keep an eye on 152. And quickly, a blast from the past. Nokia, ticker NOK. Why are we talking about Nokia in 2026?
Because in a gold rush, you sell shovels. Or in this case, networking cables. Nokia is running up close to $8 right now. It's being seen by the market as a sympathy play with Nvidia.
Because of the infrastructure needs.
Exactly. AI requires massive, massive bandwidth, and Nokia builds the physical infrastructure for that. It's a slow mover compared to US tech, it's boring, but some investors see it as a safe accumulation play for generational wealth.
And one final loser for the week, Palo Alto Networks, PAN-W.
Down 6.8% on February 18th. The reason was simple, they cut their full-year profit guidance. In this specific high valuation market, you absolutely cannot cut guidance. If you do, you get punished instantly. That's the rule right now.
Brutal efficiency.
Mm.
Okay, part 3. We've done the macro timeline, we've done the idiosyncratic stocks. Now we really have to look at the storm clouds forming, geopolitics and commodities, because this is where the war premium lives.
This is the shadow hanging over the entire market. Look at oil prices. WTI and Brent both rose about 2% to hit 6-month highs this week. Brent is sitting around 71.70. WTI is around 66.40.
And this isn't about economic demand, right? This is purely about fear.
It's fear of a major supply disruption. Tensions with Iran are escalating rapidly. We have concrete reports of Iranian military drills effectively shutting down the Strait of Hormuz for brief periods.
And the Strait of Hormuz is the main choke point for global oil.
Exactly. If that closes for real, oil skyrockets. Add to that President Trump actively warning of potential military action. And then on the flip side, Saudi exports are currently sitting at 6-month lows. So you have a tighter physical supply meeting a massive, unpredictable geopolitical threat.
Which usually sends people running to safe havens, and gold is shining right now.
Gold is trading near record highs, right around $4,980 per ounce. Silver also popped about 5% midweek. This is your classic risk-off behavior. When investors get genuinely scared of a U.S.-Iran conflict, they dump paper assets and they buy metal.
But here is the anomaly that stood out to me. Usually when people are scared of war, they also buy U.S. government bonds, treasuries.
Yeah.
But that didn't happen this week.
No, it didn't. And this is arguably the most important signal to watch out of everything we've talked about. U.S. Treasury prices actually weakened, which means yields rose. The 10-year yield moved back above 4.0%.
Explain that contradiction for us. Why aren't people buying bonds if they're terrified of a war?
It goes back to the inflation fear we talked about with the PCE data earlier. Investors are worried that the war combined with tariffs and government spending will drive inflation back up. And inflation eats the value of fixed-rate bonds. Plus, with the strong data preventing the Fed from cutting rates immediately, there is no Fed put to save the bond market. So you have this very weird situation where stocks are shaky, but bonds aren't providing their usual safety net either.
That is a very dangerous correlation. If stocks fall and bonds fall together, there's really nowhere to hide for a traditional portfolio.
Exactly. Well, except maybe crypto.
That was my next question. How is Bitcoin handling all this geopolitical stress?
Surprisingly, it's just sleeping. Bitcoin is trading quietly in the mid-60,000s. It hasn't reacted violently to the war news or the tariff news yet. It's just sitting on the sidelines waiting for a catalyst.
Just watching the chaos unfold from afar.
For now. But as we know, Bitcoin rarely stays quiet for long.
Very true. So that brings us to the summary. Looking ahead, next week sounds incredibly heavy.
It's massively heavy. We have the Nvidia earnings, which is the literal litmus test for the entire AI rally. If they miss, or honestly, even if they just beat by a little bit, the market reaction could be wildly volatile because expectations are sky high.
Then we have that IMF report on the 25th.
The Article 4 report. Think of it as the IMF's annual physical exam for the U.S. economy. If the IMF comes out and explicitly criticizes U.S. fiscal sustainability, pointing at our debt and spending, that gives the bond vigilantes a reason to sell treasuries even harder.
And finally, the vote on February 24th.
The U.S. Congress voting on the Iran War Powers Resolution. That will tell us exactly how close we actually are to a kinetic shooting war. It moves the needle from political posturing to actual conflict.
Okay, we have thrown a lot of information at you today. Ticker symbols, support levels, geopolitical treaties. We need to do the responsible thing here before we sign off.
Right. Please remember, while we discuss specific technical levels like that $415 line on Tesla or the floor breaking on Grail markets are highly volatile and inherently risky, we are discussing information from our sources to help you understand the macro flow, but this is absolutely not financial advice. You must do your own research and understand your own personal risk tolerance.
Absolutely. Do not bet the farm based on a deep dive.
Exactly.
So here is the final thought to chew on over the weekend. We are in a truly bizarre moment in history. We have robots doing backflips in China, promising this miraculous sci-fi future. We have tariffs vanishing in Washington, promising free trade. But we also have real war drums beating in the Strait of Hormuz.
It's a complete paradox.
It is. The market seems to be pricing in a future that is simultaneously miraculous thanks to AI and chaotic thanks to geopolitics. But here's the question for you. If the AI story actually stumbles next week with Nvidia and the war anxiety spikes with that congressional vote, where does the safe money actually go when both bonds and cash are under pressure from inflation?
That is the multi-trillion-dollar question right there. And right now, the answer really isn't clear.
And that's exactly why we'll be watching the tape so closely. Thanks for taking this deep dive with us today. Good luck navigating next week. You're going to need it.
Stay safe out there.